People think they lose money because they pick the wrong stocks. They don't. They lose money because they can't control themselves for more than 48 hours. I turned $18 million into $14 billion at Fidelity Magellan by beating the market for 13 straight years. And you know what the real secret was? It wasn't finding the next Microsoft or predicting market crashes. It was learning to master the 6 inches between my ears. Because the biggest threat to your wealth isn't inflation, recession, or some Wall Street conspiracy. It's you, your emotions, your ego, your inability to sit still when you should, and your compulsion to act when you shouldn't. Markets go up and down. That's just what they do. But people go absolutely insane, and that insanity costs them everything. I'm Peter Lynch, and today I'm going to explain the psychology of money in a way nobody else will. Because what I'm about to tell you will make you uncomfortable. It should. Because recognizing your own psychological demons is the only way to stop them from destroying your financial future. When I was running Magellan, the average investor in my fund earned far less than the fund itself. How is that possible? Simple. They bought when the fund was hot after a great run, when they felt excited and safe. They sold when it was cold after a rough quarter, when they felt scared and uncertain. In other words, they bought high and sold low, then complained the system was rigged. The system isn't rigged. Human psychology is just predictable, and predictably terrible at investing. Here's what nobody wants to admit. Most investors lose not because they pick the wrong stock, but because they can't control their emotions long enough to let the right one work. They buy when it feels good and sell when it feels bad, then call it strategy. But it's not strategy, it's just emotional reactivity with a portfolio attached. I've watched it happen thousands of times. Brilliant people, doctors, lawyers, engineers, people with advanced degrees, who can solve complex problems in their field, but can't resist panicking when their stock drops 15%. They know intellectually that volatility is normal, but emotionally, they can't handle it. So they sell at the bottom, lock in their losses, then watch from the sidelines as the stock recovers and reaches new highs. The market doesn't destroy these people. They destroy themselves. The market just provides the arena where their psychological weaknesses get exposed and monetized. When I was young, I thought intelligence would save me. It didn't. I made plenty of mistakes early on, not because I couldn't analyze businesses, but because I couldn't control my own impulses. I'd get excited about a hot sector and chase it. I'd get scared during downturns and consider selling good businesses at terrible prices. Intelligence didn't protect me from emotional thinking. Only experience and discipline did. The graveyard of finance is filled with smart people who lost their tempers, their discipline, and eventually their money. The smarter they were, sometimes the worse they behaved, because they thought they could outthink the market. They couldn't. Nobody can. The market has a special way of humiliating people who think they're clever. Here's what I learned over decades. Investing success isn't about being smart, it's about behaving well. It's about temperament, staying calm when others panic, staying rational when others chase miracles, staying patient when others demand immediate results. Most people don't realize it, but investing is a psychological endurance test disguised as a math problem. You win not by predicting the next move, but by surviving your own impulses long enough to benefit from compound interest. And yet, survival is exactly what most people fail at. They can't stand boredom. A stock sits there going nowhere for 6 months, and they get antsy. This is dead money. I should be in something more exciting. So they sell and chase whatever's hot. Then their old stock finally starts moving, right after they sold it. Tale as old as time. They can't resist excitement. Some meme stock is up 200% in a week, and suddenly their boring, profitable companies feel like failures. FOMO kicks in. They convince themselves this time is different, that they've spotted a real opportunity. They buy at the top, it crashes. Repeat. They mistake activity for progress. They think because they're trading, researching, watching CNBC all day, they must be doing something productive. They're not. They're just burning money on fees and taxes while getting worse returns than someone who bought an index fund and went fishing for 10 years. The late Benjamin Graham said, "The market is a voting machine in the short run and a weighing machine in the long run." Most people never stay in their portfolio long enough to see the weighing. They panic and jump off the scale the moment it tilts against them. You can't fix that with an MBA or a spreadsheet. That's a character problem, not an IQ problem. And character doesn't compound like capital. It's built the hard way, by enduring discomfort without doing something stupid. If you want to understand why people go broke, don't study economics. Study psychology. Better yet, study evolution. Because our brains evolved to survive the jungle, not the stock market. And that mismatch is costing you money every single day. Back in the caves, if you saw a predator, you ran. Immediate action saved your life. If you found food, you ate it immediately. Delayed gratification meant starvation. That wiring kept our ancestors alive. Now it makes you buy high and sell low. Fear and greed, the two oldest forces in human psychology, still drive 99% of financial behavior. It's not that people don't know what to do, they just can't do it. I've watched investors sit on gold mines and still find a way to panic themselves out of them. The stock drops 10% and they act like it's the end of civilization. Meanwhile, the patient investor quietly gets rich doing nothing. I once said, the first rule of compounding is to never interrupt it unnecessarily. But that's exactly what people do. They interrupt their own success because boredom feels unbearable. They can't leave well enough alone. And then there's envy, the deadliest force of all. Envy makes everything worse. Your neighbor doubles his money on some speculative trade, and suddenly your own solid plan feels stupid. So you copy him, right before his luck runs out. You abandon a lifetime strategy for a moment of keeping up. Envy is the one emotion that doesn't even give you pleasure. At least greed feels exciting. At least fear is trying to protect you. Envy just eats you from the inside while you pretend to be rational. It's a guaranteed way to destroy both your peace of mind and your portfolio. I've watched this happen 1,000 times. A person buys a great business, holds it for a few years, it's doing well. Then they hear their buddy made 500% on cryptocurrency in 6 months. Suddenly their 80% gain over 3 years feels pathetic. They're embarrassed. They feel like they're missing out. So they sell their great business and chase whatever's hot. Then they lose money. Then they're angry. Then they blame the market. The market didn't do anything. Their psychology did. You can't reason with envy. It's not logical. It's biological. That's why I call it the monkey in the mirror. No matter how old or educated you get, it's still there, grinning back, daring you to act stupid. Most people lose money not because they're unlucky, but because they can't tell when they're being driven by that monkey. Here's the pattern that plays out every single market cycle. When you're greedy, prices are high. When you're fearful, prices are low. So most investors spend their lives doing the wrong thing at the wrong time for the wrong reasons. Let me give you real examples. March 2020, COVID hits. Market crashes 34% in 1 month. Fastest crash in history. People are terrified. Death counts on TV 24/7. Everything feels like it's ending. What did most investors do? They sold everything. This is the Great Depression 2.0. Cash is king. I'm getting out. What did I and other experienced investors do? We looked at our portfolios, evaluated our businesses, and mostly did nothing. Some of us even bought more. Not because we weren't scared. Everyone was scared. But because we understood that fear, while real, wasn't a strategy. What happened? Market fully recovered by August. Hit all-time highs by year-end. Everyone who panicked and sold at the bottom locked in permanent losses. Then they were too scared to buy back in. They missed the entire recovery, one of the greatest buying opportunities in a decade. Then 2021 comes. Market's booming, everything's going up, crypto to the moon, meme stocks, NFTs, everyone's making money, or so it seems on social media. This time is different. New paradigm, money printer go brr. What did most people do? Jumped in with both feet. I'm missing out. Everyone's getting rich but me. What did experienced investors do? We sat on our hands. We didn't chase. We waited, and we got called old, stupid, out of touch. You don't understand the new economy, boomer. Then 2022 happened. Market crashed. Crypto crashed 70%. Meme stocks gave back everything. NFTs became worthless JPEGs. All those diamond hands turned to paper. All those people who bought at the top in 2021 are still underwater, still hoping to break even. This is the pattern you need to burn into your brain. When you feel like you should sell, when your gut is screaming at you to get out, when you can't sleep at night checking your portfolio, that's usually when you should hold or buy. When you feel like you need to buy, when everyone around you is making money and you're missing out, when it feels like easy money and you'd be an idiot not to get in, that's usually when you should wait or sell. Your emotions are designed for short-term survival, not long-term wealth building. They will bankrupt you if you listen to them. One of the most dangerous delusions in investing is the belief that you're in control. You're not. Not over markets, not over timing, and often not even over yourself. The human brain hates uncertainty, so it invents patterns where none exist and calls it analysis. We build models, read charts, create narratives, all to feel a little less helpless. But most of what happens in markets is random noise dressed up as meaning. And most of what people call skill is luck with good PR. If you can't predict your own mood tomorrow morning, how can you predict global economics for the next decade? Yet people try. They watch CNBC like it's the word of God. They read analyst reports like they contain secret knowledge. They trade based on news headlines. It's all theater. Entertainment masquerading as information. I've said this before. If you think you can predict the market, you're either a fool or a liar. And most of Wall Street is a clever combination of both. When I ran Magellan, I didn't try to predict what the market would do next week or next month. I focused on one thing: understanding the businesses I owned. Is this a good company? Is it well managed? Are people buying its products? Will it be more valuable in 5 years? Those questions I could answer. Where the S&P 500 would be in 6 months? I had no idea. Nobody does. The market is going to do whatever it wants. Your job isn't to predict it. Your job is to endure it. And that's a psychological skill, not an analytical one. Everyone wants to be rich. Nobody wants to suffer for it. That's why so few people stay wealthy. They can't handle the emotional cost. Getting rich is hard, but staying rich is harder, because wealth demands a level of discipline most people only have during poverty. When you're broke, you're forced to be cautious. When you're rich, you start believing you're bulletproof. You take risks you wouldn't have taken before. You get complacent. You think the rules don't apply to you anymore. That's when the market sends you the invoice. I've watched it happen over and over. People win, then forget how they won. They start chasing new thrills, new deals. They mistake motion for progress. They forget that compounding only works if you don't interrupt it. Every fortune eventually faces its test, not from the market, but from the owner's psychology. When you have more money than you need, the real challenge becomes not losing your mind, and markets will test you. They'll shake your faith, mock your patience, seduce you with shortcuts that look clever but rot your discipline. Most people can't stand watching their portfolio drop 30%. But that's the entry fee for long-term wealth. You don't get the returns of equities without the volatility. You just decide whether you'll pay for it with temporary discomfort or permanent stupidity. Discomfort is temporary. Stupidity is permanent. The problem is people confuse temporary pain with permanent loss. They sell great businesses because the stock price fell. That's like divorcing your spouse because they caught a cold. Pain is part of the process. It's the market's way of checking who actually deserves the reward. I remember the 1970s, inflation, pessimism, oil shocks. Stocks were cheap because nobody wanted them. I bought when others despaired. Not because I enjoyed suffering, but because I trusted arithmetic more than emotion. Years later, people called it brilliant timing. It wasn't timing. It was tolerance for pain. Patience is boring, and that's exactly why it works. The market is designed to transfer wealth from the active to the patient, and the patient are always in short supply. Everyone wants compounding, but nobody wants to wait for it. They love the idea of time doing the heavy lifting, until they realize time moves slowly. In an age where people measure attention in seconds, waiting years feels like punishment. But wealth doesn't grow on your schedule. It grows on the market schedule, and the market doesn't care how bored you are. I've often said, the big money is not in the buying or the selling, but in the waiting. Most people hear that sentence but don't understand it. Waiting doesn't mean doing nothing. It means resisting stupidity while time compounds your sanity. You sit on good businesses. You ignore noise. You let arithmetic perform its quiet miracle. Most investors don't lose money because of bad ideas. They lose because they couldn't wait long enough for good ideas to work. It's like planting a tree and digging it up every few weeks to check if it's growing. That's not investing. That's financial anxiety disorder. Patience requires faith, not in the market, but in your own process. You have to believe in arithmetic more than emotion, in time more than timing. I once waited over 20 years for some investments to deliver full value. Imagine trying to explain that to a generation that gets angry when their Amazon package is late by a day. That's the real psychological challenge, learning to be at peace with slowness. You can't rush compounding any more than you can rush the seasons. You can only avoid interrupting it. During those years of waiting, the world will tempt you to move. There'll be bubbles, crashes, new paradigms, experts shouting predictions. The patient investor learns to smile politely and do nothing, because action is often the enemy of outcome. People love to complicate simple things. It makes them feel intelligent. But in money, complexity is usually a disguise for confusion. The truth is, wealth has always come from the same few principles. Spend less than you earn, invest what's left, don't interrupt the compounding. That's it. 3 sentences. But try telling that to someone looking for excitement. Most investors can't stand simplicity because it feels too plain to be profound. They want algorithms, secret indicators, insider insights. They want the illusion of sophistication. But markets don't reward sophistication. They reward discipline. It took me decades to learn that the older and wiser you get, the simpler your worldview becomes. Everyone says they want to think like successful investors, but they skip the part where we do almost nothing most of the time. We don't chase, we don't predict, we don't confuse activity with achievement. We prefer obvious ideas executed patiently over brilliant theories executed poorly. Here's a little secret. The world's best investors spend more time reading and thinking than buying and selling. That's because they understand something the rest don't. Decisions compound the same way money does. Make fewer but better decisions, and you win by subtraction, not addition. The average investor does the opposite. They collect data like hoarders, mistake complexity for control, and drown in information while starving for wisdom. The best financial system in history rewards the exact behaviors that feel least exciting. The path to wealth looks like this: earn consistently, save consistently, invest rationally, wait endlessly. That's it. But that formula doesn't sell newsletters. So instead, the world promotes noise. If you understand this, you stop treating the market like a puzzle and start treating it like a partnership between your capital and your character. Because in the end, your returns follow your behavior, not your brilliance. In the end, money doesn't change you. It just shows you who you already were, in high definition. If you were disciplined, money amplifies your discipline. If you were reckless, money gives your recklessness a larger stage. The psychology of money isn't about money. It's about character. You can't buy rationality. You can't outsource judgment. You can't rent wisdom. You either earn them through pain and patience, or you stay a permanent student in the school of expensive mistakes. I've lived long enough to see all types: brilliant fools, humble winners, envious losers, lucky idiots. They all made or lost money for the same reason: their temperament. Markets will always test you. They'll tempt you when you should be cautious and scare you when you should be calm. If you don't know who you are before the storm, you'll find out the hard way when it hits. Your behavior matters more than your brain, because behavior is the bridge between knowledge and results. And most people burn that bridge with emotion. The wise investor accepts that imperfection is permanent. You'll never eliminate fear or greed. You just learn to observe them without obeying them. That's what maturity looks like in finance. Not certainty, but composure. The irony of money is that once you understand it deeply, you stop being obsessed with it. You realize the purpose of wealth is freedom, not display. Security, not status. I've never envied the person with the bigger yacht. I've envied the person who sleeps soundly. Peace of mind is the ultimate dividend, and it's paid only to those who stop confusing appearance with substance. So here's how the psychology of money really works. You learn over time to detach your self-worth from your net worth. You stop reacting to noise. You start thinking independently. You make peace with the idea that getting rich slowly is still the fastest way that actually works. It sounds simple, but it's the hardest thing in the world, because it requires you to win a war, not against the market, but against yourself. And that's the one war most people never even realize they're fighting. The market isn't your enemy. The economy isn't your enemy. Your neighbor's success isn't your enemy. Your own psychology is. Control it, and you'll never need luck. Ignore it, and you'll wonder why everyone else is getting rich while you're stuck. I beat the market for 13 years, not because I was smarter than everyone else, but because I learned to control the person staring back at me in the mirror. That's the only edge that matters. That's the only edge that lasts.